Hello, in today's video we're going to be taking a look at the Monday, October 6, 2025 trading session for the CBOE SPX index utilizing the day trading GPS SPX Daily Key Levels indicator, specifically the newest version of the indicator V2.0 that was released 2 weeks ago. If you have an interest in purchasing this indicator, you can reach out to us and email us at daytradinggps@gmail.com to request a discount promo code to use to purchase the indicator in the link found in the description of the video. All of our indicators are sold on a one payment for lifetime access basis, so you just make one payment and then you have access to the indicator for life. Okay, so some of you may already be familiar with how this indicator works, but for those who are not already familiar with this indicator, it is a level-to-level trade management indicator, and the way it works is that when you have it on the CBOE SPX symbol on your TradingView chart, at 9:30 a.m. Eastern New York time at the SPX market open, you will get the levels on your chart for today's session. These levels are also available at 9 o'clock a.m. Eastern time, 30 minutes before the CBOE SPX open as well, for those who want to see the main levels early to sort of get a jump on the trading session and start looking at planning some trades for that session. And the way that you would do that is the indicator also works on a second symbol, which is the SPX 500 8-cap Forex CFD. And I'll bring that chart down now for that. Okay, so this is the SPX 500 8-cap. So the way it works at 9 a.m., if you wish to see the levels early, is that when you have your chart on a second symbol, the SPX 500 8-cap symbol on TradingView, then at 9 a.m., you're going to get the levels for the SPX 500 8-cap CFD on your chart. And you have this table down here, which is the same levels for the SPX 500 8-cap, but then you also have the second table here, which is displayed at 9 a.m., and these will be the CBOE SPX index levels for today's session. So you get that. We have the 9 o'clock candle marked off here. So these will appear at 9 o'clock on this SPX 500 chart. The reason that the levels cannot be displayed at 9 a.m. on your CBOE SPX chart is because the way PineScript and TradingView works is that you have to have a tick on the chart, and the CBOE SPX index is closed until 9:30 a.m. when it opens. So the only way that we can give you the levels, even though the indicator already knows what the levels will be for the CBOE SPX index, even though it hasn't opened yet. It already knows what the levels will be at 9 a.m. Eastern, and so the only way that we can show you those so you can get a jump on the session is by displaying them on the second symbol in a second chart. Excuse me, a second table on the chart here. So when I go back to the other chart here, you'll see that these levels, the bull bear KPL of 67, 39, 48, and all these other levels, are the same levels that appear on your CBOE SPX chart at 9:30. Okay, so here we're back on the CBOE SPX chart. So at 9:30, this is how the chart will look here. You'll have the levels on your chart, and you'll have that table that you saw, that second table you saw on the other chart will be the only table on this chart here. Now this table is like something that you can turn off if you don't wish to have it on your chart, because you do have the line labels on your chart as well. So it would only really be necessary if you were zooming in like we have done here and you just wanted to know what the other levels were outside of the zoomed in levels. So preferably when you're starting off the session, it's usually better if you zoom in, say from R3 down to S3 or R2 down to S2 to give you more granular view of the price action that's occurring at the open. Okay, so you'll see that we're on a 2-minute chart here. This indicator works on chart time frames of 1 minute up to 30 minutes. So the maximum time frame you can use with this indicator is 30 minutes, and the minimum time frame is 1 minute. The recommended time frames for utilizing this indicator for trading are going to be primarily the 2-minute chart. You will see that on our other SPX trading videos on this channel that we always have the 2-minute chart for using this particular indicator. So that is the recommended time frame. However, if you find a different time frame works better for you, then like I said, you can use time frames from 1 minute up to 30 minutes. Okay, so as I stated, the most important level here is going to be the bull bear key price level, which is abbreviated KPL. We'll also be referring to it as the BBKPL throughout the video. And this is going to be the level that is going to be in play typically 90 to 95% of the time during the first, say, 2 minutes to 15 minutes or so of the session. So when you have your chart open on SPX CBOE, the default levels that will be on your chart that are the indicator default levels are going to be the R1 through R6, S1 through S6, and then you'll see these other levels here. Some of these levels I've manually enabled, some of them are on by default. So when you're using this indicator, you can make your own default layout that if you prefer a different layout, but just for telling you what the default is that you're going to have the BBKPL, you're going to have the R1 through R6, S1 through S6, and then you're going to have this QL above and QL below the BBKPL, your midpoint above and midpoint below the BBKPL, and then you're also going to have these other levels, which are YDH, YDL, YDC. So what these are is YDH is the previous day's RTH session high. So since this is Monday, that would be Friday's session because that was the last trading session. So that was Friday's RTH session high. This is Friday's, this YDC here is Friday's RTH session close, and this is YDL is Friday's RTH session low. Here, PMH is the pre-market high for today's session, and this is the pre-market low for today's session. Now these are also levels that are very important because they can also act as additional support resistance, and they're especially important where you see them in confluence with the other key levels, such as here where you have YDH right very close to R1, and you'll see here you have YDC very close to S2. Now I do have some of these other midpoints and QLs turned on. Those, for example, this mid R1, R2 up here, that's not normally turned on by default. You can turn them on manually, or you can set them as a default if that you prefer. Okay, so the way this indicator works as far as taking trades off the bull bear key price level, like I said, 90-95% of the time during the initial part of the session, this level is going to be in play. So as an example, today was another example of that. So we have entry number 1, which was a bearish entry on 9:30 a.m. So this is the first candle here, 9:30 a.m. of this session. So as you can see here, excuse me, the candle tried to go up to touch the bull bear key price level. It fell short of it, and then it closed below the bull bear key price level. So this is a bearish entry signal. If you wish to take a trade off of this candle, this would be your bearish entry signal, and the trigger level is the bull bear KPL. So this would be a bearish entry off of the close of this candle. This is a 2-minute candle, so this is 9:30 closing at 9:32 a.m. And then how, with this indicator, you decide on which strike that you're going to use is you're primarily going to use 0 DTE options. You can also use 1 DTE options, which would be, since today's Monday, that would be 1 DTE would be the expirations for tomorrow. However, we recommend the 0 DTE, but that's completely up to each trader. If you feel more comfortable with 1 DTE options, that's up to you. But the examples that we're showing here are with the 0 DTE options. So how you decide, now that this is a bearish entry, which strike you're going to use. So when using this indicator, you basically, when the trigger level is the bull bear key price level, as is the case here on this opening candle, your standard option play is going to use the at the money strike that is closest to the bull bear KPL, because that is the trigger level for this particular opening candle here. Because we have on the opening candle, we have a close below the bull bear KPL. So in this case, for today's session, since that price is 67.3948, the closest strike to this is going to be your 67.40 strike, because SPX trades in 5-point increments on options. So for example, you have 67.30, 67.35, 67.40, 67.45. So the at the money closest to this is 67.40. So that would be the 67.40 put option. We have the thinkorswim data box here. We'll also take a look at the thinkorswim chart for this option as well. But I've gone ahead and put the data box here to show you the close of the candle, $11.20, and here was also the open, high, and lows of this candle. But what you're waiting for is you're waiting for the close of the candle to make sure what is going to be the bias here at the open if you're going to take this trade. So with the close of the candle being below, that would be a put. So a 67.40 put, buying on the close of this candle, $11.20. So if you're not familiar with how options work, the price is $11.20, and so the cost of one of these put options would be $1,120. You get that by multiplying the price of the option times 100. So if you're buying one option, it would be $1,120. If you're buying two options, then it would be 2 times $1,120. If you're buying 5, it would be 5 times $1,120. Excuse me. And if you're buying 10, then it would be 10 times that, so it would be $11,200. Okay, that's your primary option for a bearish play from the bull bear key price level. Well, what are your other options that you can use? The other option, how you figure out what the other options are, is you simply look at what is the first midpoint below. That's your first out of the money option that you could also utilize. And you look at that price, 67.3366. So the closest strike to that is going to be your 67.35 put. Or your final option, because you don't want to go more than one level out, if you're going to use an out of the money option. You don't go more than one level out for an out of the money strike. In this case, one level out below, since it's a bearish play. And in this case, 67.2784, so the closest strike to that is 67.30. If this instead was, say, 67.2684, then the closest strike would be 67.25, because the midpoint between 67.30 and 67.25 would be 67.2750. So if it's a little bit over, then you go ahead and default to the nearest strike to that, which would be 67.30. If it's under, in between, then you would default to the next one, which would be the 67.25. Okay. Normally you would pick the at the money. I would say it just really depends on the trader. Some people like the out of the money options because they cost less, but remember, it also has to move more in order. It may cost less, but it's also going to have to move more in order to give you a good profit as well. So that's the trade-off with those. They cost less, so you have less money at risk, but they also need to move more. So that's really up to the individual trader. Today we're just going to be looking at what the standard options are, which are going to be the at the money options. Okay, so now what's the stop loss that you use on this trade? It's really pretty simple. You just, if the trigger level is the bull bear key price level, then you would use as a standard stop loss is the first midpoint above the level that the trade is triggered and derived from. So in this case, since that level happens to be the BBKPL, we simply look to the first midpoint above, and that is our standard stop loss on this bearish play. If instead this was a candle in reverse and enclosed above, and we were looking at a call option and a bullish play, then it would be the first midpoint below the level it's derived from. Okay, and just a side note here, we will be going over in the last 25 minutes of this video how to take trades off of the other levels, how to take bullish and bearish trades off of the R1 through R6 levels, as well as the S1 through S6 levels as well. So just so you know, your trades are not confined to taking trades off whether it's above or below the bull bear KPL. So this is not your only trading level with this indicator. All of your main levels are trading levels, the R1 through R6, the S1 through S6, plus the bull bear KPL, and we will explain how to take trades off of those other bullish and bearish trades off of those other levels as price moves throughout the rest of the session. And we will also explain in the last 25 minutes of this video the two types of trade entries, one being your standard trade entry, and then the other one being a more conservative approach to trade entries, and how to recognize the difference between the two. So that will be the last 25 minutes of this video after we get through with talking about today's session. Okay, so what about if you want to use a tighter stop loss? Well, in this version of the indicator, we introduced the auto plotting of the QL levels above and below each main level. So even though we only have these two turned on here, and then we also turned on this one for this trade down here that we'll get to in a little while, the QL above and QL below levels are available to turn on from any main level in your user control panel. We do have, and that also goes for midpoints between each level. So we do have a video, a features and setup video, which is about an hour long, which goes over all the features. There's many more features of this indicator, which we will not go into in this video today. But if you'd like to see the video about all of the different features and all the user inputs that this indicator offers. You can also reach out to us at daytradinggps@gmail.com to request the link to that video, and I can send that to you to look at as well. That is a video that you do get when you purchase the indicator as well, but if you'd like to look at it prior to making a decision of whether you would like to purchase the indicator or not, you can certainly send us an email requesting to get the link to that video. And you can also, as I mentioned earlier, request a discount promo code in return for you taking your time to watch this video today if you were thinking about purchasing the indicator. Okay, so if you instead want to use a tight stop loss, your tight stop loss on a bearish trade from this level here is going to be the QL above the level. So basically, your tight stop loss on a bearish trade from the level that you're trading from is going to be the first quarter level, or QL, above that level. And your standard stop loss on a bearish trade from the level you're trading is simply going to be the first midpoint level above the level that you're trading from. And that's out as we've outlined here and also here in this note. As you can see here today, neither one of these came close to being breached on this particular trade. However, I would tell you that, if you prefer using the tight stop loss over the standard stop loss, that the trade-off with the tight stop loss is that there are going to be times where it is going to get stopped out. So that is going to be stopped out more often than the standard stop loss. So you just have to keep that in mind if you choose to use the tight stop loss. So in today's session, on both trades, the tight stop loss was not breached in either case, and of course neither was the standard, but there will be days where the tight does get stopped out, whereas the standard does not. So you just have to keep that in mind. Okay, so we have our entry, we have our strike, which in this case was the 67.40 put option. We have our stop losses. Now what about target exits? That really just depends on what type of trader that you are, whether you're just looking for a quick scalp or are you looking for a normal trade with a normal exit. So if you are the type of trader that you prefer quick scalps, then your take profit on this trade is going to be a one level move. And that one level move is calculated from the level that the trade is derived from, in this case the bull bear KPL, and since it's a bearish trade, it would be one level below. So the first main level, full level below, is your S1 level, whereas the mid BBKPL S1 is your first midpoint level. That's a half level move, where the S1 would be a full level move between the BBKPL and S1. So as you can see here, just a few minutes later at 9:40 a.m., if only scalping, a scalp is a one level move BBKPL to S1. So when you entered here, then if you're just scalping, then as you can see here on this candle here at 9:40 a.m., it goes down, it touches this level and closes here. So when this 9:40 a.m. candle closes here at 9:42 a.m., since this is a 2-minute candle, then it is $15.18. So you have a profit from 11.20 to 15.18, so that's roughly $400 on a scalp per option. So if you're only scalping, you're looking for a one level move. Now, if you are looking for a normal move, your target exit on a normal move with this indicator is going to be, the minimum target is a 1.5 level move. So since this is a half level, this is a full level, you simply look to the next midpoint level below, and that is mid S1, S2. That is your 1.5 level move. So we have, this is the level it's derived from. This is one level. This is 1.5 levels. S2 would be 2 levels. So your minimum regular exit that you would want to close out 100% of your options, it would be a 1.5 level move from the level that the trade was derived from. So that happened at 10 a.m. here, closing out the put on a 1.5 level move, BBKPL to mid S1, S2 hit, which you can see happened here. The price on the close of this candle is $21.90, so that's a profit of $1,070 per 67.40 put option. So if you had one option, that's $1,070. If you had two options, that would be $21.40. If you had 5 options, that would be $5,350. If you had 10, it would be $10,700. Now, that's a minimum target, 1.5 level move for closing out 100%. Okay, so everything below that, such as a 2 level move or beyond, would be additional options for you to consider. So at this 1.5 level move here, your choices are A, you can close out 100%. B, you can adjust your stop loss to break even plus a profit buffer, or just break even. Or if you're trading multiple, and what you're doing in that case is you're hoping that it's going to go down further to say S2 or mid S2, S3, or yesterday's daily low, or the S3 level or beyond. And then you would keep adjusting your stop loss as it goes down if you're trying to hold on to all of your contracts. And a lot of this has to really depend on whether you're trading one contract or you're trading multiple contracts. Do you just want to close out 100%, or if you're trading multiple contracts, do you want to scale out of them? If you're trading multiple contracts and you want to scale out of them, then what you would do is at the 1.5 level move, then you would sell 70 to 90% of the contracts that you started with, and then you would adjust the remaining contract, the stop loss on the remaining contracts to break even or better meaning adding at least like a 10 to 15% cushion. Okay, so as an example, here where it's $21.90, you paid $11.20. So if you adjusted them to break even, you would adjust your stop loss to $11.20. If you added 10%, that would be about another $1.15. If you added 15%, then that would be roughly about $1.60. So let's just say you did that, 15%, $1.60 added onto this would be $12.80. So it really depends on what you're looking for. Obviously, if you want to give it more room, you could just make it break even, or if you want to adjust it so that if it does retrace, that you're at least going to have a profit, then on anything that gets stopped out, then you would add on a cushion of profit, and then as it keeps moving down, you would keep adjusting your stop loss accordingly as it keeps moving in your favor. However, in most cases, it is best to go ahead and close out your contracts at the minimum 1.5 level move or 2 level move target. And if you are scalping, then of course you are just getting out at this 1 level move and you're not doing any adjustments or anything, because scalping by nature is that you're just looking for a quick in and out. So and that would be on the one level move here. And as you can see here, we had the $15.18 here, so you made a profit of roughly $400 on the scalp. So in utilizing this indicator, you just have to decide what is your process, what are you happy with as far as, or what do you feel comfortable with as far as the profits that you wish to derive from it. Or, you know, are you really more of a scalping trader, or are you looking for just your normal profits, which would be getting out at the 1.5 level move to 2 level move? Or are you the type of trader that likes to do stop loss adjustments, and you're trying to look for maximum profit and to see how far a move may go by tweaking your stop losses, and also scaling out of trades by selling, like as I said, 70 to 90% when you reach the minimum target, and then adjusting your stop loss on the remaining runners. So as an example, if you were trading 10 contracts here, 70 to 90% would mean you'd be selling 7, 8, or 9 of them when it hits this level here. And then you're leaving, if you sold 7, you're leaving 3. If you sold 8, you're leaving 2. If you sold 9, you're leaving 1. And then you're adjusting you're closing out, and then you're adjusting the stop loss on either that 1, 2, or 3 remaining contracts to break even, or break even plus the profit buffer that we discussed. Okay. So your standard play here then is that you're getting out, well, this 1.5 level move and closing out. And then at that point, you're open to seeing if you're still trading. You know, if you're, again, if you are, some traders just like to make one trade and then that's it, and call it a day and go do something else the rest of the day, and just trade, early in the morning in the session and leave it at that. But if you're trading throughout the rest of the session, then at this point you're closed out of this trade, and now you're looking for another opportunity, which comes here on this candle at 10:20. So in here you're out, and now you're looking for another trade. And so we have this push to here, and then we have this close above here. We have a cross above and close above the S1 level, and that's followed by a retest here at the 10:24 a.m. candle, which you can see I've outlined in a note here. Bullish entry on 10:20 a.m. candle close above S1 level on this candle here, and then or confirmable retest on 10:24 a.m. candle, which is this candle here. Okay, so this would be a bullish entry. So on this bullish entry, the level it's derived from, remember this first trade here was derived from the bull bear KPL. Well, this trade here is derived from the S1 level. Okay, so now how do we decide which option strike to use now for this bullish play? Well, you're just using the same process. So this is the level that the trade is derived from. The price of this level is 67.2784, and so the closest strike, since this is over the 67.2750 midpoint between 67.25 and 67.30, then the closest at the money strike is going to be the 67.30. So it's the 0DTE 67.30 call option. And if you wanted to use out of the money options on this bullish play, you just basically use the same process that we did when we explained the other options up here, except in this case, whereas in the first case, since that was a bearish entry, we were looking for out of the money ones below. Since this is a bullish entry, we're looking for alternative out of the money alternatives if you want to do those instead, then you would look above. So the out of the money alternatives are going to be the first midpoint above, 67.3366. So that would be the 67.35 call, and your final out of the money one that you would consider would be the 67.40 call, because that is one full level above. So you're not going to look at out of the money options more than one level away from whatever level you're trading from. So just like here, where we had a bearish play, we were only looking for if we were considering out of the money ones, we were only looking at ones at the midpoint below or the full level below. Same thing except in reverse here. We're looking at one level, except this time, since it's a bullish play, one level above. So your options are either at the money, which that's what we've done here, or if you prefer to look at out of the money instead, then you look a half level above up to a full one level above. Okay, so the 67.30 call option on this candle close here, this first close, cross and close above, is $8.10 on the close of this candle. If you waited for the retest confirmation candle here instead, then this price was a little bit less than the $8.10, but we're just going to go with this particular initial confirmation here of the cross above and close above, and that is $8.10. So your stop loss on this bullish trade that's derived from S1 is going to be the first midpoint below the level it's derived from, which in this case S1. The first midpoint below it is mid S1 S2, 67.2202. So when you take this trade here with this 67.30 call, this is going to be your standard stop loss. If instead you wanted to use a tight stop loss, then you would use the QL below S1, that's the first quarter level below. So as you can see here, neither one of those came close to breaching. However, as I did mention earlier, that when if you prefer using a tight stop loss, then you'll have less money technically at risk because you're using a stop loss that's closer. However, it is more prone to getting hit. So just keep that in mind. Okay, so you have the same process here. If you're just scalping, then you're just looking for a one level move. What is a one level move from S1? It's a full one level move back up to the bull bear key price level. Because this level here above is a half level move, and then this is the next full level. So here at 11:46 a.m. you have the hit, the one level hit. If only scalping, a scalp is a one level move, S1 to BBKPL. So on the close of this candle here, of the 11:46 a.m. 2-minute candle, the price of this 67.30 call is $13.90. So that would be a profit of $580 per call option. So if you have one, that's $580 profit. If you have two, that's $1,160. If you had 10, then that would be $5,800. However, we're really looking for, unless we're scalping, at least a 1.5 level move. So at 1:22 p.m. we finally have the 1.5 level move, and again it's 1.5 levels because here's the S1. What's the next main level above this level? That's one level, and then a half level above that, that's 1.5 levels from the level the entry was derived from. So at 1:22, close out the 67.30 call on 1.5 level move from S1 to BBKPL R1. Price on the close of the candle, $16.60. You paid $8.10, so that's a profit of $850 per 67.30 call option closing out here. As you can see here, we did not make it up to R1. We did make it up to the PMH level. So in, the PMH level, you could also use that as, an additional take profit level if you wanted to, since it is sort of in confluence with this. It's not as close as this level here or this level here, but the PMH is an important level, so you could have just also gotten that on this level here. But if you're going to look at and get out at a 1.5 level move, then you would just stick with the rule of just getting out here, because that was your 1.5 level move. Okay, so right now we're going to take a look at the Thinkorswim option charts for both the 67.30 call and the 67.40 put, which I do have the data boxes here as you've seen, but we'll just take a quick look at those just so you can see the timestamps on those particular option charts. Okay, so here we have the 67.40 put. Here's the 9:30 a.m. Now this is on a 2-minute chart as well. So you have the 9:30 a.m. candle, the close $11.20. Here is where if you were just scalping, so at 9:40 a.m. S1 level scalp, $15.18. Here's the 10 o'clock candle here on the 67.40 put, the close $21.90. Next, we'll take a look at the 67.30 call. Here's the 67.30 call. And remember, we had 2 potential entry candles. One was at 10:20, so that was the cross and close above S1, and that was $8.10. And then we had the 10:24 retest bullish confirmation, and as I mentioned, that was a little bit cheaper. That was $7.70. But we had gone with just the initial cross above and close above, $8.10. Now, if you were just scalping, remember the 11:46 a.m. candle is this here, $13.90. And then here was the 1.5 level move, $16.60. Okay, now we'll go back to the regular chart. Okay, so as I mentioned, we're almost getting to the point where we'll go into the last part of the video, which is going to be approximately 25 minutes long, which will discuss taking entries off of all of the main levels besides the bull bear KPL and how to do that, as well as the 2 different types of entries, your standard entry and your conservative entry, and how to tell the difference between the 2. Another part of the strategy that you can use with this indicator is also, this is assuming that you have profits built up earlier in the session, is the lotto play. Now the lotto play window for the SPX starts at 2 p.m. and it ends at the 4 p.m. close. So the window of opportunity with lotto plays is generally from 2 p.m. to say 3:40, 3:45 p.m. as far as entering a potential lotto play. Okay, so there's no rule that says that you have to take lotto plays. Lotto plays are going to be high risk, high reward plays, and what you're generally looking for with those sorts of plays is you're looking for options that are going to be somewhere in the 30 to 50 cent range up to say maybe $2 to $3 range. And what you would be doing is if you have profits built up earlier in the session and you're still looking for additional trades, then if you want to take a lotto trade, you would use a maximum of 10% of the profits you have from that session as your bank for any potential lotto plays. So for example, let's say that we were just trading one option. So we took both of these trades today and we just traded one option each time. And so we had a profit here of 1,070, and then we had a profit, excuse me, we had a profit here of 850. So 850 plus 1,070, so that is, if I have my math correct, $1,920. So taking this as an example, 10% of $1,920 is $192. So if you were so inclined to be looking for some late day lotto trade options to consider, then you would have up to $192 to spend on potential lotto trades that you may want to implement during the lotto window from 2 p.m. to say 3:40, 3:45 p.m. And the thing you have to keep in mind with lotto trades is that there is a good chance that they will go to zero, but there also is a good chance that they may pay off anywhere from 4x to potentially as much as 20x or more. So that's why they're called lotto trades, because the way SPX can move late in the session, especially say in the last half hour of the session or last 15 minutes of the session, is that you can get some very high returns if it happens to move in your favor, but you also have to be cognizant of the fact that the reason they're called lotto plays is just like a lottery ticket, there's a very good chance that they will end up being worthless. So that's why if you do, if you're so inclined to look at lotto trades later on in the session, that you only want to take up to 10% of your session profits to put towards, and that would be up to that amount. Not there's no reason that you have to take all of the 10%. So up to 10% to use on any potential lotto plays. And you would use lotto plays going over the different how you would determine that is in the next section of the video, the last 25 minutes, as I talked about, when you're looking at price action on other levels that are occurring in the session at that time, and whether you want to take a bullish or a bearish play off of the levels where price is having a reaction at, then we will discuss that in the last part of the video here in the last 25 minutes as far as taking any bullish or bearish plays off of any of the levels. So with that in mind, just be cognizant of the fact that if you do lotto plays, that again, you just want to take up to 10% of any session profits if you're so inclined to be looking at lotto plays. And then that way, if you happen to have one that doesn't work out and becomes worthless, then at least you still have 90% or more of your session profits that you can take home for the day. Okay, so as I mentioned earlier, the last 25 minutes of this video will be going over all of that. And if you have an interest in purchasing the indicator, you can email us at daytradinggps@gmail.com and request a promo code for buying the indicator at a discount using the link in the video description. Alright, so now we'll move on to the last part of the video. Hello, in this video we're going to go over how to take trades off of the other main R and S levels. So this would be taking trades off other levels besides the bull bear key price level. So the main R and S levels are your R1 through R6 and S1 through S6. So if we zoom out here, we'll have R1 through R6, S1 through S6. The levels that show up as default on startup with this indicator are the PMH, PML, YDH, YDL, and YDC. So that's the pre-market SPX pre-market high, SPX pre-market low, SPX previous day RTH session high, SPX previous day RTH session low, and SPX previous day RTH session close. So the previous days are YDH, YDL, and YDC. So that's yesterday's high, yesterday's low, yesterday's close. PMH and PML are the current session's pre-market high and pre-market low. So pre-market high, pre-market low, YDH, YDC. And we move down, here's the low from the previous RTH session. Also in startup, you will have R1 through R6, the bull bear key price level, and S1 through S6. You will also have QL above BBKPL, QL below BBKPL, the first midpoint above the BBKPL, and the first midpoint level below the BBKPL. And this is because in 95% of the sessions or so, your trades at the beginning of the session, if you decide to take trades at the beginning of the session, are primarily going to be based on price action at the bull bear key price level. However, there is no rule or obligation to take trades off the BBKPL. It is there for the session bias, to give you a bullish or bearish bias for the session, as well as the trades that you can take at the beginning of, like I said before, 90-95% or so of most sessions that you will see. However, you can just wait until price action bears out further on in the session and take trades off of the main R levels or S levels. As we've discussed in other videos, when you're taking a bullish trade off of the bull bear key price level, your tight stop loss is the QL below the BBKPL on that bullish trade triggered from the BBKPL level, and your standard stop loss is the first midpoint below, which would be mid BBKPLS1 for a bullish trade taken off of the BBKPL level. Conversely, on a bearish trade taken from the BBKPL level, your tight stop loss is the QL above the BBKPL, and your standard stop loss for a bearish trade taken off of this BBKPL level is the first midpoint above the BBKPL, which is mid BBKPL R1. The same principles applies to taking trades off of the other levels. So if you're going to be taking trades off the other levels, then you simply need to turn on the quarter levels if you're going to be considering taking tight stop losses, or the midpoint levels for standard stop losses. So for example, if we're looking to possibly take bullish or bearish trades off of R1 or R2 or S1 or S2, then we would simply turn on the QL levels above and below those levels, as well as the midpoint levels. So you simply go into the user control panel And first we'll turn on the midpoint levels. So we'll enable mid R1, R2, mid R2, R3, mid S1, S2, and mid S2, S3. And let's say we're also considering tight stop losses. Then enable QL below R1 and above S1, below R2 and above R2, and then the same thing for the S levels. Above S1, below S1, above S2, and below S2. Now you can leave it this way if every day that you want to consider taking trades off of this level. Just know if you reset the settings, it's going to go back to what I showed you before as the default. So for example, right now we're just showing R3 through S3. So for example, if price is coming down to S1 and bouncing off of S1 and you want to take a bullish trade off of S1, then your tight stop loss on a bullish trade is the first QL below S1, because S1 is the level that you're taking the trade off of. And the standard stop loss would be the first midpoint below S1, which would be mid S1, S2. So instead of a bounce off of here, if price came below here, then went back up and crossed above and closed above S1, and you wanted to take a bullish trade off of S1, it would be the same thing. You're taking a bullish trade off of S1, so your tight stop loss is the QL below S1, and your standard stop loss, if you choose that one instead, is the first midpoint below S1, mid S1, S2. Let's say the reverse happened. Price is slicing through S1 and closing below S1. And you want to take a bearish trade off of S1. Then on a bearish trade from S1, your tight stop loss is the QL above S1. And on a bearish trade on S1, your standard stop loss is the first midpoint above S1. So always just remember that on bearish trades from any level, your tight stop loss is going to be the first QL above that level, and your standard stop loss is going to be the first midpoint above that level for bearish trades taken from that level. And on bullish trades taken from any main level, your tight stop loss is going to be on bullish trades taken from the main level, your QL below that level, and your standard stop loss is going to be the first midpoint below that, whatever level that is. So on R1, if we were taking a trade of a breakout above R1 and we're taking a bullish trade, then our tight stop loss is the QL below R1, because that's the level we're taking the trade from. And our standard stop loss, if we choose that instead, is the mid BBKPL R1, because that's the first midpoint below the level we're taking the bullish trade from, R1. If we were taking a bullish trade on a breakout above R2, then our tight stop loss in that bullish trade on a breakout above R2 is QL below R2, and our standard stop loss on a breakout above R2 is going to be the first midpoint below R2, which is mid R1, R2. Now, in the reverse, let's say that price goes up to R2, now it starts closing below R2, and we're looking for a bearish trade off R2 to move down below to these levels below. On a bearish trade from R2, then our tight stop loss is the first QL above R2. If we choose instead to use a standard stop loss for our bearish trade taken off R2, then the standard stop loss is the first midpoint above R2, which is mid R2, R3. Same thing if we're taking a bearish trade off of R1. If we're looking for a bearish trade off of R1 or break below R1 or a touch and fall off of R1, then our tight stop loss on the trade taken from the R1 level is the QL above R1, and our standard stop loss on this bearish trade taken from R1 is the first midpoint above R1, mid R1, R2. Same thing applies to the S levels on bearish trades. If you're taking a bearish trade based on price action coming down, closing below S1, then your tight stop loss in that bearish trade taken from the S1 level is QL above S1, and your standard stop loss is the midpoint level, the first midpoint level above S1, which is this mid BBKPL S1. On a break below S2, then a bearish trade taken from S2 is the tight stop loss for that. On a bearish trade taken from S2 would be the first QL above S2 here, and your standard stop loss would be the first midpoint above S2, which is mid S1, S2. Same thing applies on S3 levels. If this was a bearish trade we were taking because price started closing below S3, so on a break below, close below S3, our tight stop loss would be the QL above S3, which we don't have because we didn't enable it on this chart, but it would be the first QL above S3, or if instead you're choosing to take the standard stop loss for your trade on a bearish trade from the S3 level, then it's the first midpoint above S3, which is mid S2, S3. Same thing for a bullish trade above R3. Break above, close above R3, then your tight stop loss would be the first QL below R3, because we're taking a bullish trade looking for price to go up, continue going up. So you would enable QL below R3 if you want to use a tight stop loss. Keep in mind that if you're just using standard stop losses, then unless you have some reason why you want to see where the QL levels are, there's no reason to turn them on. So if you're just going to be using the standard stop losses, then you would just want to have your midpoint levels turned on, unless for some reason you also want to see, just for context, where the QL levels are. So again, in summary, if you're taking a bullish trade off of either the bull bear key price level or any main level, whether it's an R level or an S level, if it's a bullish trade, then your tight stop loss, if you choose to use that, is the first QL level below the level that you're taking the trade from, and your standard stop loss is the first midpoint level below the level you're taking the trade from. The opposite is what is on bearish trades. On bearish trades, then if you use a tight stop loss, then it's the first QL level above the level you're taking the trade from. If you're taking a bearish trade and want to use a standard stop loss level, then your standard stop loss level is the first midpoint above the level that you're taking the trade from, the bearish trade from. Bearish trade from R1, standard stop loss is mid R1, R2. Bearish trade off of R2, looking to go down, your standard stop loss is mid R2, R3. Bearish trade from the BBKPL, your standard stop loss is the mid BBKPL R1, because that's the first midpoint above it. A bearish trade taken from the S1 level, your standard stop loss is the first midpoint above S1. And again, on bullish trades, it's the opposite. It would be the first midpoint below. So if you're taking a bullish trade off of S2, first midpoint below S2 is your standard stop loss. Okay, so now we're going to take a look at examples of both standard and conservative entries, both on bullish entries and bearish entries. So first off, we're going to look at bullish entries. So here we have a cross above and close above. So we have a candle that the same candle is crossing above the level in question, in this case the bull bear KPL, but it would not matter what level it's on. So regardless of what level this is, you have a cross above and close above the level. That is your bullish entry on a cross above and close above the level in question. Your second option is take a more conservative bullish entry approach. And on the more conservative bullish entry approach, you are requiring a retest of the level, a successful retest of the level before entering your trade. So in the case of a bullish trade, you're waiting for a successful bullish retest of the level in question before entering your bullish trade. So on this more conservative option, the sequence is you have a cross above and close above the level, which we have here, followed by price falling back to test the same level successfully, meaning it's coming back down, it's not closing below the level, it's successfully retesting the level and closing above the level. So it's cross above, close above, fall back to retest on a bullish trade, close again above that level. That is your conservative bullish entry that requires a retest. Just keep in mind that if you are going to focus and use the more conservative bullish entry that requires a retest, that many times price, after initially crossing above and closing above, will just continue to keep closing above in successive candles, and there will be no retest. So just keep in mind that if you use the more conservative entry, there are going to be times where you are going to miss entries because there is not going to be a retest. In this case, there was a retest. So again, just to go over it again, the standard bullish entry is a cross above and close above the level in question, in this case the BBKPL. So you would enter on the close of this candle here. Or if taking the more conservative bullish entry approach, you're waiting for a successful retest for price to fall back to the level in question, but still close above the level in question, and that is your successful retest. So you would enter, you could have entered on this candle, or if you did not on those, you could have entered on this candle here, and it did retest the candle here. We had a retest here, but if you waited for this retest, you'd be paying a lot more. So usually the successful retest, you're just waiting for the initial successful retest. So this is the initial successful retest. This is the initial cross and close above. This is the initial retest. Okay, so just to take this one step further here, so as you can see here on the R1 level, we had a cross above and close above this level. So if you missed this entry here, or if you're just the kind of trader who you prefer taking trades off of other levels besides the bull bear key price level, then you have a cross above, close above here, and you would take that entry here, and you would base your entry on the R1 level. Now, just to clarify, the stop loss on either one of these entries here, down here, whether you took this standard bullish entry or the more conservative retest required bullish entry, your standard stop loss is the first midpoint level below the level in question you're taking the entry from. So in this case, on this sequence here, this is taken from the bull bear KPL, so your standard stop loss is the first midpoint level below the level in question, the bull bear KPL, so that is this level here. We don't happen to have the quarter levels on this particular chart, but if you instead wanted to use a tight stop loss level, then you would enable the QL below the bull bear key price level, and that would be your tight stop loss on this trade. And the QL is the midpoint between the midpoint and the main level. So on the new version, the 2.0 version, you have the auto plotting of the QL levels if you simply enable them. But here, as you can see, the tight stop loss would not have been hit either. But just keep in mind that on any entries, whether it's bullish entries or bearish entries, the tight stop loss is named a tight stop loss because it is tighter and there's more chance that it will be hit than the standard stop loss. So if you're going to use the tight stop loss, you're going to have less at risk because you're using the tighter stop loss. But conversely, the con side of that is that there's more chance of it getting hit. So you just have to be mindful of that. If you instead, like the second point we're getting at, if you waited to take an entry off of the R1 level on this cross and close above, then your standard stop loss on that trade is the first midpoint below the R1 level, which is this mid BBKPL R1. And if you instead took the tight stop loss, then it would be the QL below the R1 level, which would be the midpoint between this level and this level, which again, on the new V2.0 indicator, those auto plot as well, the QL levels. Okay, now we'll look at a bearish entry. Your standard bearish entry, you enter a bearish trade on a cross below and close below level. So here we have a cross below and close below the R2 level. So you would enter a bearish trade on this cross below and close below if you were looking to take a trade off of the R2 level and you were open to bearish trades off of that level. This would be your signal to take the bearish trade on a standard bearish entry. Your standard stop loss on this bearish entry is the first midpoint level above the level you're taking the bearish entry from. Since the bearish entry is from the R2 level, your standard stop loss is the first midpoint level above the mid R2, R3 level. And if you chose instead to use a tight stop loss level, then it would be the QL above R2, which in this case would be about right here. And again, on the new V2.0 indicator, it will auto plot that level for you if you go ahead and enable it. Now, looking at the more conservative bearish entry, it's just like the bullish one that we did, except in reverse. We're waiting for a successful retest of this level before entering the bearish trade. So in this sequence, it's basically the reverse of this sequence down here for the bullish entry. In this sequence, we have a cross below, close below candle. Then price rises back up to test the level in question and then closes below that level again. That's a successful retest of the level. So this is where you would enter on a successful retest. You could have also entered here. That would have been a little bit later, but that, either one of these candles here would be considered the successful retest. So even on the successful retest, since it's off of this level, it's the same stop loss. First, for a standard stop loss, the first midpoint level above, which is mid R2, R3, that's the first midpoint level above this R2 level. And if you chose to use a tight stop loss, it'd be the same as what we talked about with the standard entry. It would be the QL above R2. And the same thing would apply for any other level. So if this price action was happening down here on this S2 level instead of here on this BBKPL level, then it would be the same sequence. Cross above, close above, that's your standard entry. Cross above, close above, then retest and close back above, that's your conservative successful retest entry. And then your standard stop loss on an S2 level bullish entry is the first midpoint level below S2, which is mid S2, S3, and then your tight stop loss level on a bullish trade taken from the S2 level is your midpoint, the QL below S2. Okay, I hope this clarifies the entries and also taking entries from the different levels for you. Thank you.